Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey everybody.
Hey Lauren, we've visited this topic in kind of different ways, but with the consistently low interest rates that people are realizing in their CDs and in their bank accounts, they're in constant search for income. And so this article in the recent USA Today business section by John Wagner, he talked about there's basically two choices if you rely on investment income to pay your bills.
Okay.
Of course, investment, what you just talked about, option number one is using ultra-safe interest-bearing investments, such as CDs and money market funds, which we all know are very low, historically low. The other option is to take more risk, and what he talked about for 2012. Many people are taking more risk to try to get more income, and they're putting their money in junk bond funds, mutual funds, and
junk bonds.
Yeah, junk bond mutual funds or high yield junk bond mutual funds, and they to the tune of $32 billion of money was moved into those type of funds last year.
While people move money out of stocks still.
Right.
Oh,
okay. And so, last year so right now currently the current yield on junk bond funds is below 6%, which is the first time in history that's ever happened.
Wow.
And I bet last year that the typical junk bond fund grew about 14%. So, and what this article says is that one of the reasons it went up so much is that because there's so much new investment, they're driving up the prices of those bond funds.
Right, which means the interest rate is going down, which means your future expected returns are low, but those risks are all still there. I mean, junk bonds still do the same thing that they've always done. They go down when the stocks go down.
Right. So yeah, exactly. And he said on the last, the worry is that if the economy, the worry, and I've seen this for practicality, is there's people that are relatively risk averse, thinking that hey, this is a bond fund and it's not that risky, so they don't know what they're getting themselves into.
Yeah, because a lot of junk bond funds, they just call them high yield funds.
Right.
Like they don't really explain to you what's in them, and especially in a 401k plan, a lot of times it'll just say stocks and bonds, and then a lot of times the bonds they'll be just like a regular bond fund that we might recommend, and then there will be a high yield fund. And people who don't really know any better will just think, oh yeah, high yield, that's a good bond fund. And they don't realize that they're investing in something that, while it's less diversified, basically just acts the same way as, I don't remember what the exact percentage is, but it's like if you there's an almost exact correlation between a combination of small value stocks and just regular bonds.
Right. Put
those together and you get a junk bond, except that it's not that diversified.
Right.
There really aren't that many companies participating in the junk bond market.
Right.
And
the fact that companies are willing to pay the higher interest rates means that they are there's some risk with those companies down the road that you may not get your bond paid back. And then also they said when there was the last financial meltdown, the average junk bond lost 30%.
30%, right.
Including the interest that was earned that year. So I just wanted to bring this as a word of caution. There's better ways to provide income than going to junk bond funds alone, and that would be what we believe is a globally diversified portfolio of stocks and bonds.
That's right. It has the same risk profile, but it's much better diversified, and it has higher expected returns.
Okay.
So,
well, thank you for if you have invested in these high yield bond funds and would like a second opinion, please contact Lauren or myself, and we'll be glad to help. We'll see you next time in Erickson TV. Bye now.
See you next time.